Good afternoon, ladies and gentlemen. Thank you for joining us on this earnings call for first quarter FY19. I hope you've had a chance to go through our press release and the quarter results and the investor presentation which has been uploaded on our website. I'll, as usual, talk about our performance highlights for the first quarter and then open it up for discussions. My colleagues from the management team are also here with me to address your queries. On the macro front, the picture is mixed with revival of credit growth supported by both private and government consumption. At the same time, we are faced with some headwinds on inflation, interest rate movements, and global trade challenges. I'll come straight to our financial results, and which are sort of satisfactory on all counts. We continue to maintain our growth momentum across all our businesses. For the quarter ended June 18, our advances grew 36% year-on-year, and wholesale and non-wholesale businesses growing at 32% and 42% respectively. Our deposit base also continues to see strong growth at 27% year-on-year, led by CASA growth of 40% year-on-year. CASA percentage is up from 22.09% in Q1 18 to 24.42% in Q1 19. Revenue growth has seen strong momentum and has shown 38% year-on-year growth in FY19, Q1 FY19. Our net interest revenue grew 46% year-on-year in Q1 19, significantly above our loan growth. Our overall yield on advances improved 26 basis points year-on-year and 34 basis points quarter-on-quarter to 10.82% in Q1 19. I'm happy to report that in this quarter, we've crossed the 4% mark in NIMs, ending the quarter at 4.04%. On a year-on-year basis, our NIMs increased 50 basis points. This has been achieved despite an increase in cost of funds in Q1, some of which we were able to pass on through increase in MCLRs. I want to take a moment to talk about cost of funds and how we see it impacting our NIMs in the coming quarters. We've seen our cost of funds increase by 17 basis points quarter-on-quarter. Directionally, we expect cost of funds to inch up marginally from here onwards. However, we are fully confident of maintaining our NIMs above 4% owing to two important factors. First, last year our wholesale book saw a fair amount of pressure on yield front due to competition. We have increased our MCLRs over the last 6 months, and now we are seeing yields improving on the wholesale side. Secondly, our increasing share of non-wholesale businesses, which are at significantly higher yields, is helping us improve our overall yields. These two factors, in our view, are giving us comfort that we will be able to maintain NIMs around the 4% range in the near term. Our non-interest income, other income, grew 27% year-on-year in Q1 19, while our core fee income grew 58% year-on-year in Q1 19. As in the past, we continue to see strong granular growth across distribution, credit cards, client FX income, and general banking fees. We had an MTM loss on our investment book of 24 crores, which we have fully provided for this quarter, and have not taken the benefit of the RBI dispensation. In spite of this, our overall securities trading business was positive during the quarter. Our cost-to-income ratio was 50.8% for Q1 19, 200 basis points lower than last quarter and 20 basis points lower than Q1 18. However, as we continue to invest in our franchise, in branches, technology, and retail assets business, we expect cost-income ratio to be in the range of 52 to 53% for the full financial year. For Q1 19, our net profit increased by 35% to 190 crores during the quarter. And ROA for the quarter was 1.26%. ROAs improved 7 basis points year-on-year. Our ROEs also improved by 26 basis points quarter-on-quarter to 11.16% in Q1 19. We continue to broadly track on our financial parameters to our guidance for FY20. Let me now briefly discuss our business performance in different segments. Our wholesale and non-wholesale segments continue to see strong traction. The split of wholesale and non-wholesale advances stood at 59 and 41%. 59% and 41%. Our wholesale book, which comprises corporate and institutional banking, CNIB, and commercial banking, CB, we saw a growth of 31% year-on-year. Within the wholesale businesses, CNIB grew 31% and CB grew 30% year-on-year. As I mentioned earlier, we are seeing yields improve in our wholesale book as competitive pressures abate and new opportunities open up. On a Q-on-Q basis, we have seen an increase of 10 basis points in our wholesale yields, and we expect this to further improve based on the pass-through effect of MCLRs. In our non-wholesale business, contribution to the bank advances continues to inch upwards in line with our strategy of balancing the book between the two segments. The business continues to show a strong growth momentum and grew 43% year-on-year. Within this, the retail asset business grew 45% year-on-year, and the financial inclusion, or what we call DB and FI segment, grew 39% year-on-year. In terms of yields, the non-wholesale business improved yields by close to 110 basis points year-on-year and 30 basis points quarter-on-quarter to 14.04% for this quarter. This was largely on account of the changing mix of business, as highlighted earlier. Within retail assets, the card business continued to show robust growth, with the card base just shy of 1 million cards at the end of the quarter. The business continues to be among the top 5 in the industry in terms of retail spends per card as well as new card additions. We are seeing a healthy uptake of cards in the Tier 2 markets as more and more individuals are shifting their regular spends onto the card. The business now is a significant and steady contributor to core fee of the bank and contributes 40% to the total core fee income of the bank. This is largely led by a conscious strategy of issuing cards with an annual fee, which not only increases the fee contribution, but also ensures higher customer engagement and retail spends, making it the preferred card in the wallet. The card fee income is expected to grow in line with the growth in card numbers. In terms of the development banking and financial inclusion segment, before I talk about our performance in that space, I want to briefly talk about our acquisition of Swadhar Finserv Private Limited. As you would have seen in the press release, we have now acquired 100% of the equity in Swadhar. This is an important strategic acquisition for us, and by doing this, we now have control on a large part of our distribution network in this space. With Swadhar, we now have a direct presence in 18 states and union territories through 348, business correspondent branches. As you know, we have been building this business over the last 7 years with the help of our BC partners, and we believe this acquisition will enable us to scale up further to become a significant player in this segment. We see meaningful opportunity to add new products and services backed by strong technology and analytics capability. Coming to the performance of this segment, the micro-banking business continued its growth momentum and grew by 66% year-on-year as the new branches opened in the last 2-3 quarters added to the new businesses. The book today contributes around 9% of the total bank advances. As part of our geographical diversification strategy, no state contributes to more than 15% of the portfolio. We currently operate this business in 19 states. The MSME business, focusing on small businesses in the Tier 3 and 4 markets, grew 68% year-on-year, as most of the branches added in the last year have started contributing meaningfully. In microbanking, the GNPA continued to reduce, and I'm happy to report a GNPA of 2.54% as of end of Q1 19 as compared to a peak GNPA of 5.17% as of December 17 and 4.07% previous quarter. As mentioned in our last call, the demonetization impacted portfolio will be fully written off this year, bringing the GNPA of the entire portfolio to under 1% by the end of this financial year. Approximately 2/3 of the impacted portfolio has already been provided for, and the balance will be done in the next 2 quarters. The credit cost impact of the remaining portfolio is already built into our forecasts for this year. The recovery efforts on the portfolio continue through a separate collection team, and we continue to see encouraging results. The new portfolio built from January 17 continues to display strong credit behavior with 90 days plus past due at around 0.38%. Overall, we continue to be confident about the growth engines in the non-wholesale businesses, secured, unsecured businesses, and the MSME loans, credit cards, and microbanking, as the credit environment remains conducive, both for individuals and small businesses, and as we add more geographies in our distribution. Our investment into portfolio analytics, risk management, and collections continues as we grow these businesses. On to asset quality. Our bank-level gross NPA percentage was 1.4% in Q1 19 and net NPA at 0.75% against 1.46% and 0.81% respectively in Q1 18. Our restructured assets stood at 10 basis points in Q1 19. Our security receipts position was at 0.06%, and there was one ARC sale in the quarter on a full cash basis. We are flat in our overall stressed book, i.e. GNPA plus restructured at 1.5%. Deposits and cost of funds. Our deposit base continues to see healthy growth at 27% year-on-year. The CASA deposits grew by 40% during the same period. CASA ratio increased from 22.09% in Q1 18 to 24.42% in this quarter. The realization and granularity continues to increase in our deposits with healthy liquidity coverage ratios. Our cost of funds for this quarter was 6.36% as against 6.19% in Q4 18. In terms of our distribution network, we added a total of 40 business correspondent branches in this quarter. We now have a total of 266 bank branches, 847 BC branches, of which 199 are classified banking outlets. Our capital adequacy ratio is 14.57%, with Tier 1 capital adequacy ratio at 13.14% as of June 30th, 2018, with interim profits, as against 15.33% and 13.61% respectively, as at March 31, 2018. The capital consumption was slightly higher this quarter, owing to the one-time yearly adjustment for operational risk. To summarize, I would like to leave you with a few key highlights for the quarter gone by. NIMs continue to see improvement, and we have crossed the 4% milestone in this quarter. We remain confident of maintaining NIMs at above 4% in FY19. Credit costs are expected to be steady and are in line with our guidance. We have improved our provision coverage ratio to 60% plus this quarter, and we expect to at least maintain that same going forward. Our ROA and ROEs continue to improve, and we are broadly on track to our FY20 targets. Lastly, the acquisition of Swadhar is an important milestone for us. It now gives us greater control in achieving our stated objective of strengthening our market position in the inclusive banking business and allows us to aggressively pursue multi-product opportunities in this space. With that, we will now open it up for questions and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who wishes to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashish Sharma from Inam Asset Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. First of all, congratulations on a good set of numbers. So just on the NIMs and the yield part, you mentioned in your opening remarks and guidance that you expect NIMs to sustain at 4%. But we've seen this sharp improvement in yields in the non-wholesale category. Do you see this sort of a sustaining? I mean, what are the reasons for such a strong improvement in the yields? Just some color on that.
Yeah, I mean, as we said, that even on the wholesale side, we expect the yields to have bottomed out and, with the, effect of increasing MCLRs. I mean, even the wholesale yields have marginally improved in this quarter by about 10 basis points. And we expect that with some of the actions we've already taken in the last few weeks, some of that will further improve even in the wholesale segment. Okay. So, and the yields on the non-wholesale side have been attractive and they're holding up nicely. So as far as the combined effect is concerned, that despite a marginal increase in cost of funds, the overall yields we are confident can be maintained at over 4%.
Okay. Perfect, sir. And the second question would be on the OPEX. And we've seen an improvement in the cost-to-income ratio. What would be the guidance for the same? How much more improvement we can see, and what would be the sustainable run rate for the same?
Yeah, so there, we've been saying again and again that we are in a fairly active investment mode. And even during this year, we will make investments in our branches, in our technology, and in our, retail asset lending franchise, essentially on the card side, and in other areas too. So actually the first quarter typically is a bit slow when it comes to the investment program of the year. And in that sense, I think while 50.8% cost-income ratio is interesting, but it will sort of level out in the above 52% range. Yeah, so that is what we have guided, that for the year as a whole, it will be in the 52 to 53% range, which will be on an annualized basis an improvement over last year. But at the same time, we don't expect that to go down beyond that level.
Okay. That will be also perfect. Thank you, and all the best for the next quarter, sir.
Thank you so much.
Thank you. The next question is from the line of Pranav Gupta from ICICI Securities. Please go ahead.
Hello.
Yes, please go ahead.
Hello.
Yes, we can hear you.
Yeah, so on the cost side, you answered my question saying that first quarter is slightly lean in terms of investments. But if we look at your Vision 2020 and your ROA target of 1.5, what would be the major levers you would say, which will help us achieve this target?
Yeah, I mean, in the sense that, as you are seeing, that from that point of view, we have been showing consistent improvement in ROA every year. And even in this quarter, compared to the equivalent quarter last year, there is a 7 basis point improvement in ROA. So, I mean, based on the, that trend, in fact, is continuing. And And we are very confident, as we've said earlier, of maintaining that ROA improvement consistently over the next several quarters.
Okay. Also, could you throw some light on how you have seen such a stark improvement in fees from cards, and how much of that would you attribute to the partnership with Bajaj Finance, and how much would be the in-house attribution towards that?
So I think as far as the fee part is concerned, we have already commented that because of the way we run the card program with annual fee structures and so on, and also the interchange that we get on the spends, there is a strong fee generation, that happens in our card business. Now, in terms of new acquisitions, let us just say that about 40% is our direct acquisition and about 60% comes through the Bajaj partnership. But frankly speaking, in terms of contribution to fees, it is equivalent to, the number of cards being acquired.
Okay. So you'd say that attribution to fees is more towards our acquisition rather than Bajaj Finance? Is that
No. I said 40% is our acquisition and 60% comes from
the numbers.
Similar. So,
okay.
Yeah, the ratio, it's been similar ratios.
So let me give you some breakdown if that helps. So in terms of number of cards, we are roughly about half between our portfolio, which is non-Bajaj, and Bajaj co-brand cards. In terms of our outstandings, 60% is non-Bajaj and 40% is Bajaj. In terms of spends, about 45% is Bajaj and 55% is non-Bajaj. So broadly, if you see, I would say the fee income generated would be in the region of about 55-57% our portfolio, and the balance coming from Bajaj portfolio.
Okay. Thank you so much.
Thank you. The next question is from the line of Rahul Maheshwari from TCG Asset Management. Please go ahead.
Good evening, sir. I have 3 questions. First of all, during the quarter, the capital consumption on quarter-on-quarter basis has increased by 110 bits, whereas the management commentary was that normally the capital consumption would be in 40 to 45 bits. The capital consumption that has led to such a steep increase.
So Rahul, I think the first quarter has the burden of increased operational risk weight, which comes in because of the standardized approach that banks follow, wherein the calculation of the ops risk is based on the last 3 years' profit. And therefore, we add the latest year and you drop the year which was 3 years back. And therefore, the denominator, that base goes up, and therefore the percentage of ops risk goes up. That has been the predominant driver. If I exclude that impact, then I think the sequential capital consumption is slightly lower in Q1 than Q4. So we will continue to guide a 40 to 45 basis points on an average per quarter of tier 1.
Okay. And earlier you had guided that the micro banking would be restricted towards the 9% of the portfolio on our overall advances, but after acquisition of Swadhar, which is mainly into the micro banking and the MSME part, still you would stick with 9%, or it can move the needle upside?
Yeah, so you don't understand that the acquisition of Swadhar was a BC of ours, so in any case that portfolio was reflecting in our books. So currently also we are at that 9% levels, and we will continue in that range. What Swadhar does for us is it increases our distribution capability of distributing MSME as well as other products. So that's one. And second is we have a complete control on our distribution network as well. So that's the positive which it brings us.
Okay. And third, in terms of the agri exposure, what is the total agri? Because this time you have bifurcated between retail and the wholesale. But overall, where it stands, and where as a few quarters before you had told there was a stress in agri and you have taken most of the hit in terms of the provision. But now where do you find the outlook for the agri division?
Okay, so on the agri side of the business, we had last time also said that we had restructured the business and had slowed down the acquisition given the environment which is there. And if you notice the advances have come down on the retail side by almost about 13%. year on year. I think the environment is still tricky. There is a Karnataka loan waiver which is to be processed. There are a couple of more states which may go that route. There is elections which is to come in. So as of now, we are kind of maintaining our portfolio and just focusing on our existing customers till there is much more clarity around this segment.
And how much it contributes to your overall book, agri as a part?
Yes. So agri to the overall bank advances, retail agri is about 3.7%.
All of it, yeah, correct.
It used to be 5, it's kind of come down.
And how much is sitting into commercial banking, the wholesale part?
Very little.
Even put together, it's under 4%.
So, let me explain it in different ways. The total agri portfolio, corporate and retail, is under 4% of the book. It used to be 5 plus. It's been coming down every quarter. It is now under 4%. Having said that, as we have said in previous quarter also, we have restructured our approach. The corporate piece, which is very, very, very small, if you ask me to guess, it's somewhere around 250, 300 crores maximum. Yeah, which is not even a percentage or even 3/4 of a percentage of our balance sheet, is now merged with the so-called commercial banking side, because that is how it needs to be managed. That's a corporate agri, it's a wholesale activity. We are now managing it directly there. But the number is minuscule, so I don't think you should place any stress on that. That leaves the retail agri piece, which we are managing as retail agri and showing that number also. Okay, so that number, as Harjeet just pointed out, is about 3% odd, 3.7%, and that's not a significant number. At the same time, there are certain risks associated with that portfolio, which Harjeet has just explained, and I think we continue to manage it tightly and are basically managing it such that there need not be any concerns.
Okay. And there was a strong recovery on quarter-on-quarter basis during the quarter. Any of the corporate, can you highlight that what is the recovery going forward as compared to compared to the base quarter, sorry.
Oh, so it was in absolute terms, it was one particular case that we spoke about, which slipped and we recovered completely back, 100% recovery on that. Other than that, it's all granular small stuff.
So again, to re-explain that, a particular account became NPA and got recovered within the quarter. So it was 100% and 100% back. So the net effect is 0, both within the quarter.
But it is showing as additions and recovery.
It is showing as additions and recovery. Yeah.
And
that was how much? 30 crores.
27.
Yeah. The amount was 27 crores. So 27 crores technically became an NPA within the quarter, technically got recovered 100% for cash, money in the bank within the quarter. So, but just in terms of the way it has to be shown, it shows as additions 27% and then recovery 27%. Crores, sorry.
Thank you so much, sir.
Thank you. The next question is from the line of Sagar Shah from KSA Securities. Please go ahead.
Hello.
Yes, please.
Yeah, good evening, sir. My first question is regarding to wanted to know that have you factored in the bond M2M losses actually, which RBI has given the window for 4 quarters to be spread out, but have we done in this particular quarter?
Yeah, as I explained, that on a net position basis, taking an entire securities portfolio, we were on a net positive. We had a net profit in that business in the quarter. Yeah. Okay. However, there was a portion of MTM losses on the investment book as part of that. Okay. We fully absorbed that because we had enough profits. And we have fully absorbed that, and therefore nothing needs to be taken forward for the remaining quarters of the year.
Okay. My second question, sir, was regarding to, as a general, I'm seeing your unsecured advances is nearly almost 33%, sir. And I can see the tenor of the advances for this quarter has almost 71% is the below 1 year tenor of advances. So just wanted to know that what is the business model actually? How are we actually working? Are we a working capital bank or a bank of like something like we are providing more to commercial banking or for working capital purposes?
So again, this has been our basic strategy and philosophy on the wholesale lending side throughout, where we largely try and run a short duration lending book on the wholesale side, which is tilted towards short-term working capital oriented loans, where we have very strong clients with whom we have a long-term relationship, and where we are very comfortable with the credit profile. We do to some extent do some medium-term lending to those companies. Having said that, the portfolio is heavily weighted towards, as you can see, under 1 year, kind of exposure. So that philosophy of the bank has been so, continues to be so. And therefore, there's no change in that position, and the wholesale book is largely secured, as you will appreciate. So, the bulk of the so-called unsecured piece essentially comes from the non-wholesale side, where I can approximately say that 50% of the total retail or non-wholesale lending is secured and approximately half is unsecured, to understand it in simple terms.
Okay, got it. But, sir, going ahead, something like, are we targeting a more of secured as compared to unsecured, or are we comfortable with this actually?
No, we are quite comfortable with this level. We've been operating at or around this level for quite some time. We don't want to take it further towards unsecured. We don't want to also take it much further towards secured. I think this is a fairly good combination in terms of our portfolio mix. And what we do is to look at the risk rating profile of our businesses, which is also, again, reflected, on another slide, where you can see the quality of the entire asset portfolio as reflected on page 22. Yeah? It just shows you the very healthy, rating or credit rating perspective or the asset quality perspective, where in terms of ratings, as you can see, that a very high percentage, almost 94.3% is investment grade and better.
That's correct. Yeah, but
again, that number has been consistent. That number has been consistently 92-93% plus.
Yeah, for the last three periods that you have shown actually. But wanted to know that are the yields higher in the unsecured portfolio as compared to secured?
I'm sorry? On the retail side, yes. You have cards and you have microfinance, both having significantly higher yields.
Mm-hmm. Okay. Thank you, sir. All the best.
Thank you. The next question is from the line of M.B. Mahesh from Kotak Securities. Please go ahead.
Hi, good afternoon to all. I have three questions. One, if I could have the breakup of the retail loan book. Second, what would be the rough contribution of fees from the wholesale segment in your overall non-interest income? And the third question to Harjeet, this is just in continuation with what was asked in the previous quarter. At this point of time, we just wanted to understand, do we see a very, very high contribution of revenues coming in from two major businesses, which is the MFI as well as the cards business, given the fact that these are reasonably high-yielding portfolio, and whether the cards business at this point of time is breaking even at the operating profit level?
Sure. Okay, so I can broadly tell you in the retail side, roughly about 12 to 13% of the total bank advances are what we call as LAP and working capital. About 2.8 is bill. Cards is about 6.9. Agri, we said, was about 3.7. And the balance, I think, 1.2, 1.3% is what is personal loans. So that's the broad breakup for the retail. Yeah, and I'll answer your second one on the card side, where you're asking me whether we are breaking even or not. Yes, cards is not only at the operating level, cards is making money at a PBT level as well, and is delivering more than the bank ROAs as well. So it's already crossed that hump, is on the path of, therefore, increasing its profitability.
Okay, and if our understanding is right, is the contribution of the MFI and the cards business at the revenue line now crossing somewhere close to about 30%? Is the business too skewed towards these two businesses as we speak today? And more you add these small ticket loans, aren't you inherently increasing the riskiness of the portfolio?
No, so see, cards, you should not confuse cards with small ticket loans, because the risk profile is very, very different there. If you leave that aside, then you have microfinance, which, as we said, is a business which we are comfortable with a credit cost of around 1.5% on a steady state basis, including the provisions for, let's say, the events which happen. Keeping that aside, then we have LAP, which is almost about half the book of 47% of the book of retail, which is again less than 1% kind of NPA level. So from that perspective, we are fairly maintaining the mix to take care of the risk levels which is there.
And the contribution of fees to the wholesale business?
So Mahesh, it's about 60% retail, 40% wholesale.
Okay. Thanks a lot.
Yeah. One other thing, Mahesh, I wanted to just add was that during this entire time and even continuing further, a lot continues to be invested in the analytics and the portfolio management side of this business, because that's the mantra to actually run the unsecured side of the business, and that's what gives us the confidence to continue to grow cards.
Okay, we don't dispute the point that there's a fair amount of investment. I'm just saying that, when you look at the way the cost growth have changed over the last since the time you've gone into this arrangement with Bajaj, there has been significant pullback. It appears to be that there seems to be significant pullback in expenses at the bank level, especially on the liability side or probably on other segments of the business. Just trying to understand, is this good or bad?
So I just want to tell you one, I don't think that's been done. And the second is that even if I look at the Bajaj portfolio itself is profitable. So that's also breaken even and started making money. So Mahesh, basically our MFI and cards businesses are already where the costs are showing. After accounting for those costs, those are running at profitability higher than banks are. So there is, in fact, it is actually funding the potential expansion on whether it's technology, whether it's investments into branches and distribution. So I think the investments into liabilities has got multiple factors. You need to be having a certain level of control on how you grow. I don't think it is restricting us from an investment availability perspective. We are also conscious of the fact that the dynamics of that business is dramatically changing with what's happening from a digital standpoint. And therefore, while we agree that, currently the 260 branches has to go up, but we don't see ourselves becoming a 1,000-branch bank as a necessity at all. And so those are the factors which are also critical in our inputs onto how do we grow that business.
Fair enough. Thanks a lot for this.
Thank you. The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, just on your retail loan book, sir, I just wanted to know where we have seen, pick up in the yields. So what percentage of this retail book would be, let's say, new to credit customers?
Very marginal, actually. If I was to break it up, LAP and business loans, none. Everything is to credit-tested customers. Cards, maybe about 10%. is new to card, and in microfinance, about 25% is new to this. So otherwise, so it's broadly, I can very safely say that, almost the entire piece is to credit customer.
I think just to add, I don't think the correlation is between a higher yield and a new to bank or a new to credit customer at all. I think one of the peculiarities was that the microfinance business, given a lot of NPAs in the last year from a base standpoint, is now kind of getting written off and fully provided for. So that optically is increasing the yield as well. So there is no correlation between an increased yield that you're seeing versus any extra risk that is happening. There is no change at all in the risk profile of that business.
Sure. And sir, I mean, if you can also provide a rough breakup of this self-employed and salaried also within, let's say, LAP or, so basically that, so LAP is anyway, so that is not required. And, and secondly, sir, on this Swadhar acquisition, the employee that we have inherited, has they been absorbed in the banks or how does it work? I mean, are they still, let's say, under the banner of Swadhar, or they would be at some point of time would come under banks purview?
No, they continue to be in Swadhar's and under Swadhar banner and would continue to remain so. This will always remain. It will run as a distribution arm of the bank as a subsidiary and will be an independent entity from that part of it.
Sure. Yeah, that would be it, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Ritesh Bajatia from Asian Market Securities. Please go ahead.
Hello. Yeah. Thanks, sir. My question is already answered. So thanks for the opportunity.
Thank you.
Thank you. The next question is from the line of Ravi Singh from Ambit Capital. Please go ahead.
Yes, sir. Could you help us understand qualitatively which are the areas where investments are still going on and, driving OPEX growth of 40% or so, in the context that around 59% of loan book is corporate and commercial, where theoretically operating leverage should be very high, and that segment also has also been growing at 30-40% in recent years. And our OPEX to assets at 2.9% is similar to a predominantly retail bank. So what is the disconnect here? I mean, what are those investments which are driving the high cost base? And how should one look at the OPEX growth in relation to the loan growth over coming years?
Yes. So see, I think we mentioned earlier as well that part of it is going in the retail side of the business where the acquisition or the book growth is what is driving this. If you look at it, we've still not reached a size where our new acquisition or new growth which is coming in is of let's say a smaller multiple of the book itself. So if you look at it, we're almost doubling our book every year, which means we're acquiring more than what we have, which is what is resulting in a high upfront load in terms of an acquisition cost, which is concerned. And that's what drives up your operating margins. So while these businesses make money, the run rate expenses of these businesses, as long as this growth continues, will be there till our base becomes big enough to be able to absorb the acquisition.
Fair enough. So beyond the new business and new customer acquisition cost, is there any large, big investment still pending? Or do you think that part is over in terms of distribution extension, IT, or any major investment left here?
Yeah, Ravi, I think as we mentioned, the three areas of focus really starting with branches, a lot of investment in technology, digital, and the third is really expansion of our retail client acquisition, scaling up, as Harjeet mentioned. So all these three areas are getting the focus. Obviously, this phases out over a quarter, so you have to kind of see it over a long period of time, but these are the three areas of investment. And even as we, let's say, increase our branches, it's not necessary that the RM count will be the same as we used to have earlier, because we have many different ways of accessing customers digitally first and then servicing them through RMs or a call center. So there are many channels which are not so geared up as a traditional bank would have 5-8 years ago. So it's a little different mix of channels, physical, digital, as well as partnerships, which is driving the investment upfront.
Okay. Got it. Thank you, sir.
Thank you. The next question is from the line of Kashyap Javeri from Emkay Global. Please go ahead.
Yeah, hi, and thank you for the opportunity. Congratulations for the solid numbers that you have reported for the quarter. I've got two questions. One, in your Tier 1 ratio, have we adjusted this year's dividend, in quarter 1 Tier 1 ratio? And second question is that if I look at your, savings account deposits, for now almost about 4 quarters, now we are at about, 5,500 to 5,800 odd crores. So in the overall great numbers, this is one number which is sort of not showing growth. Any particular reason?
So, on the first question, no, we haven't taken dividend because typically we don't want to kind of assume what dividend will be paid out. So that part will come one shot in Q4.
No, so now under the new accounting standard, the previous year's dividend will be provided once you pay out, right? So that number...
That was more an accounting presentation in any case.
Right.
Typically, if we have to look at capital and therefore profit addition, one methodology could be that you assume a dividend that will be paid out for this year and proportionately reduce it quarter on quarter. We haven't done that. It is not reflected basis the change in accounting that is happening. It is anyway just an estimated number in that sense.
Okay.
So dividend has not been accounted for.
Okay.
On the savings account side,
between September last year and June this year, there has not been much change actually.
In what?
In savings account deposits.
Yeah. So on the savings account side, essentially what we've been really concentrating on is to make sure that the mix between granular deposits and slightly large ticket, high NW customer kind of deposits starts to improve for us. When we had launched the savings account drive essentially 3 or 4 years back, Task was a very big segment that we had gone after, but that also came at a slightly higher cost. So we've been kind of making sure that our granular deposits grow very, very significantly. So what we've done is we've got more stable deposits, we've got more granular deposits, and obviously our cost of acquisition has therefore come down on that as well. So you may find a little bit of a slow growth on the high value ticket size, but overall the quality of the franchise has improved tremendously. So we are now in a very, very comfortable position, and I think the numbers will keep going up from here.
Okay. Thank you. That's it from my side. Thank you very much, sir.
Thank you. The next question is from the line of Shirish Jain from NVS Brokerage. Please go ahead.
Thank you for the opportunity, sir. So my question is, how much of the NPA portfolio belongs to the unsecured part of the advances and how much is towards the secured? If you could provide us the proportion.
One way of understanding that is to go to page 24. Yeah?
Okay.
And you find that it gives you the split of the gross NPA of 1.4% of the bank as a whole, and of which 22 basis points is coming from a large corporate business, 50 basis points is coming from the commercial banking business, which means about 72, 73 basis points, a little more than half is coming from wholesale businesses, which are 85 to 90% secured. The good side is that approximately less than half is coming from the non-wholesale businesses, of which also approximately half is secured and approximately the other half is unsecured. So it is well distributed more or less equally, across the different segments of the bank. So if the wholesale portfolio, which is largely secured, has 60% of or 59% of the total, advances of the bank, then approximately 52-53% of the NPA is also coming from that category. And on the other side, again, it is equally distributed. So, therefore, there is no skew, if I may say, towards one or the other category. Yes. Now, in terms of just the model rates, if I may say, the unsecured businesses, which are cards and microbanking, potentially will have a slightly higher levels of, model risk. And therefore, the provisioning requirements will be relatively higher. But then you start looking at all of this from the point of view of risk-adjusted returns. And when you look at that story, then they more than justify, carrying that level of risk. And as has already been articulated, that both the microbanking portfolios and our card and other, non-wholesale portfolios are more than justifying, from a ROA basis, which are running at above the bank averages, significantly above in some cases. Therefore, they justify that level of risk.
Yes, sir. Understood, sir. Thank you, sir.
Thank you. The next question is from the line of Alok Ramachandran from Future Generali Life Insurance. Please go ahead.
Yeah, sir. Thank you for taking my question. Sir, just wanted to, I must have missed it. Sorry for coming late in the call. Any treasury losses during the quarter and any RBI dispensation that you have taken for the quarter?
No problem. Just to say what we said earlier, we had some MTM losses on our investment book, but our overall trading position was positive. We had a net gain. Therefore, we could absorb the whole thing and yet have a net gain in the quarter. So we did not have to, and we did not choose to spread these over the subsequent quarters of the bank.
All right. And what is the duration that you run on this portfolio, sir?
So, HTM would be about 5.5.
But HTM is not relevant.
On the AFS book, sir?
The AFS book would be about 2.5 years.
All right, sir. Thank you so much, sir. Yeah.
Thank you. The next question is from the line of Anand Ladha from HDFC Mutual Fund. Please go ahead.
Hello, sir. So just a couple of questions from my side. Sir, if you can give the breakup of a retail loan book in terms of absolute amount, how much is LAP, personal loan, credit card, and accordingly, if you can give the YOY number of same quarter last year.
It's there on page 20.
So I just kind of, I think a couple of questions back summarized the retail split, where we said that between LAP working capital, it's about 13% of the total bank advances are towards this. About 2.8 is bill, 1.5 is personal loans, 6.9 is cards, and 3.7% is agri.
Okay. And what could be the number last quarter? In the sense Q1?
I think more or less the difference you will see is that today when we say LAP, we are talking of about 45-46% of the retail asset book. That time it used to be about 51%. And that difference has moved in because cards has come in, which used to be earlier a very less number. So that's been the major change which has happened. Rest more or less 2% here and there is what is the change.
So your disclosures are quite detailed. If you can add a disclosure for retail assets also in terms of breakup of that, that would be great, sir. Secondly, sir, if you can also give us some color, like what's the outstanding credit card numbers we have, how has been the addition to the credit card this quarter, and if you can give some color, how has been the average spend of the credit card between your own credit card as well as in between Bajaj credit card, joint issued.
Well, Ajit will continue, but we've been giving out a card number every quarter. It's not that we've not been giving. We've actually been giving. We gave it just now also. We said that it's just under 1 million cards. Okay, and we gave the number last quarter and previously also. Yeah, so we've been giving those numbers. It's not that we're not giving those numbers. Having said that, I think on the spend, I think you...
Yeah, so the card numbers as of quarter end was 9.77 lakhs, 9.8 lakhs. As we said, we were just a shade below 1 million. We roughly add about 60,000 additional incremental cards every month currently, and our spends blended between RBL and the Bajaj portfolios is about 10,500 rupees per card.
Okay, this is 10,000 per card per month.
10,500 per card per month. Yeah, that's right.
And sir, if you can just give some color, like what could be our cost of SA saving account?
About 6.2.
Okay. Thank you. That's from my side. Thank you.
Thank you. The next question is from the line of Rahul Gupta from Morgan Stanley. Please go ahead.
Hi, Sumit here. I had a question on processing fees. That has been growing below the balance sheet growth or the loan growth in fiscal 18, even this quarter. So wanting to understand what's driving that. And is that one of the reasons why, like if I think about the acquisition cost on retail loans and part of that logically should get offset by processing fees. So is the gap between the two going up, and that's one of the reasons playing out in terms of cost-to-income ratio? Thank you.
So with processing fee, corporate processing fee will have its little bit of up and down. Q4 is sometimes better, Q1 is weak. Retail fees would pretty much grow in line with the asset book. I don't think there is any noise around that, generally speaking. So that was on the fee part. What 30% YOY. And the processing fees grown at about 30% YOY, which is, shade lower than what our advances growth has been.
Yeah. The other question of yours, just wanted to tell you that on the retail loan side, the processing fee is lesser than the cost of acquisition. So there is a gap. That gap is steady. It's not changed, but it is. So net, you do have a little bit of a negative drag for your LAP, business loans and personal loans acquisition.
The first year acquisition, yeah.
Got it. And the second question is, would you give indicative retail loan yields? Loan yields is basically LAP and cards.
Yeah, so LAP is in the region of about 10.4%, and cards interest yields is in the region of about 20%.
Okay, thank you. That helps.
Thank you. The next question is from the line of Bobby Jairam from Falcon Investments. Please go ahead.
Going forward, what's going to get you to the 1.5% ROA? Is it going to be higher NIMs or lower cost, or how's it going to work? ROA.
So I think it will be driven by both NII to assets and fee to assets, partly compensated by cost to assets. And obviously provisioning to assets is something which is harder to predict, but that should also come down.
So will the NIMs move above 4%, much above 4%? Do you see that over the next couple of years?
So not necessarily in the next 2-3 quarters, but I guess if you look at next year, yes, we could increase that, but primarily because of the mix change. So we do intend to see that the 61-40-39 ratio will probably move towards a little more towards retail. And as that portfolio on a blended basis is higher yielding, I think that will drive part of the improvement in NIMs. And obviously, as we improve our CASA ratio, that also helps in bringing cost of funds down. Obviously, the fact that we will increase leverage over the next 2 years will be a drag because contribution of equity to total liabilities keep coming down. But despite that, we expect margins next year to be better. This is what we are seeing today.
So you're fully on target for the FY20, your target of 1.5%.
We should be definitely between 1.4 and 1.5. Maybe exit quarter should be closer to 1.5.
Right. Okay. Thank you.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential Asset Management. Please go ahead.
Thanks for taking my question. On the SAR cost particularly, the SAR cost which is currently 6.2% now, what was it last year same time?
Similar. I don't think there's been any change.
No.
Much higher. June it was more like 6.6.
Okay, sorry.
Last year June it was about 6.6.
Okay, this is tying up to the answer that we gave that the task segment contribution has come down.
Okay. And what proportion of your SAR balances are now over 10 lakh rupee balances?
Just give me a minute. I'll give you that figure. So I have a cut above 1 crore. It's about 40-odd% above 1 crore for us.
40% of the SA balances are above 1 crore plus. Okay. And so you can talk a little bit about your Abacus traction?
Sorry, can you say
Abacus traction.
Okay. So on the Abacus, which is the code name or the internal name for our digital savings account proposition, we've been seeing good traction over that proposition in terms of the number of accounts that we've been sourcing, and obviously we've been trying to put a lot of effort around the customer base being acquired in a way to make sure that the balances improve as well and the product holding ratio of these customers improve as well, because that's how I think the overall proposition will become very, very relevant as we go along. So the traction on the numbers is very good. Like we had said earlier, we almost source as many accounts digitally as we were sourcing from the physical world. The value pool in that segment is still much lesser than the physically acquired accounts, but we've seen a very good improvement in the average ticket sizes as well over the last 9 months or so. But the most encouraging factor that we are now seeing in this portfolio is that as and when these customers come into the bank on a digital platform, the propensity to buy all the other digital products that we are selling is very, very high. And not necessarily at the same time, but the engagement with the bank has gone up significantly in the last 9 months that they've been on the book. So very happy with the experiment. We will assume and we hope and we are very confident that over the next year or so, the value pool will start to become very significant as well and will also become a very big channel for an overall acquisition for all products of the bank for us.
So can you just share a few numbers here? So how many SA accounts are we mobilizing every month? Of them, how many are digital, how many are physical? If you can just throw some numbers.
Those numbers will be a little difficult to share on this call, but like I said, roughly as many physical accounts as we source are being sourced digitally as well now.
Okay, half of them are digital through the digital.
Yes, in terms of numbers, yes.
And on the cards business, what is the ROA now?
What cards business is higher than bank ROA? We do.
See, we don't give out product level ROAs. But safe to say that it's higher than the bank ROA.
Okay. And you gave the spend. Okay, sure. And how many of the 4.9 million customers are MFI customers?
MFI customers are close to about 2.9 in fact.
Okay. Thank you so much. All the best.
Thank you.
Thank you. The next question from the line of Onkar Bhugandari, an individual investor. Please go ahead.
Yeah, hello.
Yes, please.
Yes, hello.
Yes,
yeah, I just wanted to ask, in next 5 years, where do you see RBL Bank more as of a retail-oriented bank or a wholesale-oriented bank? And what would be the mix?
Onkar, I think we've been very clear that progressively we will build balance on our portfolio. You can track the last 3-4 years. You'll see the percentage of retail contribution increasing. And that's not the fact that wholesale is regressing. Wholesale is increasing too, but the relative contribution is changing. And I think progressively you'll see retail contributing more and more. Also, I think what's important to understand is that underlying every segment we do is a whole 360-degree philosophy around the customer. So it's just not regarding the assets. There's a lot more some of which is in progress, some of which will happen over the course of the next several quarters. So the idea is to bank the full wallet of the customer as much as possible. And in wholesale, while advances may not grow at the same pace as retail, but there's a larger focus on trade, guarantees, letters of credit, payroll, digital cash management service, etc., which necessarily does not reflect in the advances, but the overall profitability of the business. So our philosophy is balance the book, but bank the entire wallet to the extent we can.
Okay, so the share will be definitely moving, right? Moving up.
It is moving up.
Okay.
So if you see last June, our relative contribution by wholesale was 61 to 39 retail, non-wholesale, and right now it's 59 to 41. So in a span of 4 quarters, it's shifted 2 percentage points.
Mm-hmm. So it should be like, can it be 50-50% in next, say, 5 years?
Maybe before that. Yeah.
Okay. Thanks a lot.
Thank you. We'll take the last question from the line of Pranav Gupta from ICICI Securities. Please go ahead.
Firstly, it's Pranav from HDFC Securities. So my question is, given the growth rate that our bank is delivering and our Tier 1 at 13.1%, what level of Tier 1 are you comfortable at, before you can raise capital or you look to raise capital?
Yeah, I think if you take a consumption rate of 40 basis points to 45 basis points, then I think, as we had suggested last quarter also, this gives us a runway of, about 7 quarters plus before we hit the 11% sort of Tier 1 level. And I think that's the time when it becomes sort of prudent, I would say, to think of the next capital raise, for the bank. So therefore, I think translated into, real terms, it can see us through this year and the next financial year.
Okay. And lastly, just a data point, could you give us the breakup of provisions, credit and non-credit?
About 100 crores, 110 crores. About 110 crores is provisions related to NPAs.
110.
Sorry, and standard assets. That includes standard assets. Then we have about 25 crores of provisioning on bond book, and the others would be other provisions.
Okay, great. Thank you.
Thank you. We now conclude the Q&A session. If you have any further questions, please contact RBL Bank via email at ir@rblbank.com. I repeat, the email address is ir@rblbank.com.